The psychological architecture of the modern financial consumer is built upon a deeply embedded, profoundly dangerous hallucination, born in the smoldering wreckage of the 2008 subprime mortgage collapse. The global public, traumatized by the sudden vaporization of trillions of dollars in paper wealth, was aggressively conditioned by the corporate media, the Treasury Department, and the central banking syndicate to accept a fundamental macroeconomic falsehood. The citizenry was taught that the brutal interventions of 2008, the massive multi-billion-dollar taxpayer bailouts, and the unprecedented expansion of the Federal Reserve's balance sheet were temporary emergency measures executed to save the free market from a localized anomaly. The phrase too big to fail was introduced into the global lexicon as a solemn vow, a promise that the state would act as the ultimate unyielding backstop against systemic collapse, while simultaneously assuring the public that heavy regulatory oversight would permanently prevent the apex predators of Wall Street from ever threatening the global economy again. This narrative is a completely mathematically fabricated illusion. The events of 2008 did not fix the systemic rot at the core of the fiat currency matrix. They institutionalized it. The global financial system did not deleverage, it did not de-risk, and the massive commercial banking syndicates did not become safer. Instead, the exact opposite, terrifying mathematical reality, unfolded over the subsequent 18 years. By utilizing the infinite unbacked printing press of the central banks to artificially suppress interest rates to zero, the sovereign state effectively poured highly combustible rocket fuel directly onto a smoldering fire. The megabanks that were deemed too interconnected, too massive, and too systemic to be allowed to face the natural, unforgiving consequences of free market, their balance sheets into monolithic, heavily concentrated financial leviathans. To understand the terrifying paradigm shift that defines the global economy in 2026, one must first deconstruct the theatrical performance of modern financial regulation. Following the 2008 crisis, the political elite paraded the Dodd-Frank Act and the Basel III capital requirements as impenetrable shields of consumer protection. The central banks proudly broadcasted the results of their annual stress tests, algorithmic simulations designed to mathematically prove that the commercial banks possessed enough liquid capital to survive a severe economic downturn. These stress tests are the ultimate financial placebo. They are meticulously engineered, highly sanitized mathematical models that deliberately ignore the true apocalyptic vectors of systemic contagion. They assume a manageable rise in unemployment or a predictable dip in commercial real estate, but they completely, willfully blind themselves to the catastrophic, interconnected reality of the global derivatives market. The derivatives market is the invisible multi-quadrillion-dollar dark matter of the global financial universe. It is an incomprehensible, sprawling web of highly leveraged synthetic paper contracts completely untethered from the physical, productive reality of human labor or tangible commodities. The monolithic banks, sitting at the absolute apex of the financial food chain, do not make their true fortunes by issuing standard mortgages or facilitating small business loans. They generate massive synthetic profits by acting as the primary counterparties in this unregulated, opaque casino, trading interest rate swaps, foreign exchange derivatives, and complex collateralized debt obligations. The gross notional exposure of these derivatives completely dwarfs the total gross domestic product of the entire planet. If a single critical node in this hyper-connected algorithmic web violently fails, the cascading chain reaction of counterparty defaults will instantly vaporize the microscopic, highly touted capital reserves mandated by the post-2008 regulations. This brings us to the exact mathematical singularity of 2026. The financial elite have fundamentally exhausted the architecture of the bailout. The paradigm has violently, irreparably shifted from too big to fail to the absolute terrifying reality of too big to save. To comprehend why the bailout mechanism is mathematically dead, you must examine the sovereign balance sheet of the United States government. In the autumn of 2008, when the global banking syndicate stared into the abyss of total insolvency, the United States national debt stood at roughly $10 trillion. While historically high, the sovereign state still possessed a microscopic margin of fiscal maneuverability. The Federal Reserve and the Treasury Department possessed the balance sheet capacity to absorb the toxic, hyper-leveraged garbage from the private banking ledgers and transfer it directly onto the backs of the American taxpayer without immediately shattering the global confidence in the fiat dollar. the state was strong enough to carry the corpse of the banking sector. By 2026, that sovereign strength has been completely mathematically eradicated, driven by decades of relentless, unfinanced kinetic conflicts, explosive entitlement obligations, and the compounding parabolic interest required to service the debt of previous bailouts. The national debt of the United States is rapidly approaching $40 trillion. The United States Treasury is currently issuing trillions of dollars of new sovereign bonds simply to pay the interest on the old bonds. This is the absolute textbook definition of a terminal Ponzi scheme. The sovereign state is currently consuming the entirety of its own domestic tax revenue just to prevent an immediate, catastrophic default on its own debt. Therefore, when the hyper-leveraged monolithic megabanks of 2026 inevitably face a cascading liquidity crisis triggered by the total slow-motion collapse of the commercial real estate sector, the implosion of the shadow banking apparatus, or a violent dislocation in the sovereign bond market, the mathematical physics of the rescue operation simply do not exist. In 2008, the government bailed out the banks. In 2026, the banks are mathematically larger than the government's capacity to absorb them. The toxic assets sitting on the balance sheets of the consolidated apex predators are so astronomically massive that a traditional bailout would instantly, violently snap the spine of the fiat currency itself. If the Federal Reserve attempts to execute a 2008-style rescue operation today, they would be mathematically forced to print tens of trillions of unbacked digital dollars in a matter of days. They would have to aggressively monetize the failure of the entire global derivatives market. In 2008, this massive liquidity injection was successfully trapped within the upper echelons of the banking system, inflating asset prices, but failing to immediately trigger highly visible, hyperinflationary consumer prices on Main Street. The velocity of money had collapsed, but in the highly volatile, supply chain constrained, completely saturated macroeconomic environment of 2026, the physics have changed. If the central banks unleash tens of trillions of synthetic fiat dollars to bail out the too-big-to-save institutions, that liquidity will instantly, violently overflow the containment of the financial sector. It will flood directly into the physical economy, instantly chasing a finite supply of agricultural calories, physical energy, and manufactured goods. It would trigger an immediate, catastrophic, hyperinflationary firestorm that would completely, permanently destroy the purchasing power of the United States dollar on the global stage. The central banking syndicate is staring at an impossible terminal binary choice, a macroeconomic checkmate that they engineered themselves. They can allow the free market to finally, ruthlessly clear the deadwood. They can allow the monolithic megabanks to physically fail, triggering a massive deflationary depression that wipes out trillions of dollars of synthetic paper wealth, completely erasing the digital ledger of the global economy and forcing a total agonizing reset of the standard of living. This would require the political elite to surrender their power and admit absolute historical defeat. Or they can attempt the ultimate terminal bailout. They can attempt to save the banks by infinitely expanding the fiat money supply, sacrificing the currency to save the bondholders, and plunging the global working class into a state of unmitigated hyperinflationary starvation. The transition from too big to fail to too big to save means that the sovereign shock absorber has been entirely destroyed. The risk has not been mitigated. It has been transferred, compounded, and concentrated at the absolute highest level of the global architecture. The next systemic banking failure will not be a localized crisis requiring a government intervention. It will be a sovereign, and the architects of the global financial syndicate fully understood the lethal mathematical reality of their sovereign debt crisis long before the public ever felt the initial tremors. Following the absolute, highly publicized outrage of the 2008 taxpayer-funded bailouts, the central bankers recognized a fatal political vulnerability. The working class, having watched millions of homes foreclosed upon while Wall Street executives received multi-million-dollar bonuses from the public treasury, would simply not tolerate another direct, visible extraction of their tax dollars to save the apex predators. The political optics of a traditional bailout had become entirely, structurally toxic. Therefore, the syndicate executed a brilliant, devastating legal sleight of hand. They did not fix the banks. They fundamentally changed the legal architecture of bank failure. They quietly transitioned the global financial system from a framework of bailouts to a framework of bail-ins, legally shifting the catastrophic burden of systemic collapse directly onto the shoulders of the unsuspecting depositor. To comprehend the sheer magnitude of the trap that has been set for the 2026 global economy, one must completely unlearn the fundamental, deeply ingrained assumption of what a bank deposit actually is. When a citizen walks into a massive, heavily branded commercial bank and hands the teller a stack of physical currency, or when their employer directly deposits their biweekly fiat paycheck into their digital checking account, the citizen operates under a profound psychological hallucination. They believe that money is sitting securely in a vault, completely segregated, waiting patiently for them to withdraw it. They believe they own that money. This is a complete, undeniable legal fiction. The moment your fiat currency crosses the digital or physical threshold of the commercial banking institution, it ceases to be your property. Under the strict, uncompromising definitions of modern financial law, you have just provided an unsecured loan to a highly leveraged speculative investment syndicate. You're no longer a customer. You have been legally downgraded to the status of an unsecured creditor. This legal classification is the absolute terrifying linchpin of the modern too-big-to-save paradigm. In the aftermath of the 2008 crisis, international regulatory bodies, operating primarily through the Financial Stability Board and codified during the G20 summits, quietly mandated a global restructuring of bank resolution protocols. In the United States, this was embedded deep within Title II of the Dodd-Frank Act, operating under the sterile bureaucratic moniker of the Orderly Liquidation Authority. In Europe, it was enacted as the Bank Recovery and Resolution Directive. These highly complex legal frameworks dictate exactly what happens when a monolithic megabank mathematically fails. Because the sovereign state is completely financially incapable of printing the tens of trillions of dollars required for a traditional bailout without instantly triggering hyperinflation, the new laws mandate that the failing bank must be recapitalized from within. When the massive multi-trillion-dollar derivatives book of a globally systemic bank violently implodes, the bank will instantly freeze all operations. The doors will lock, the ATMs will go dark, the digital login portals will display a permanent maintenance error. At that exact moment, the regulatory authorities will execute the bail-in protocol. They will look at the liability side of the bank's balance sheet, which consists entirely of the checking accounts, the savings accounts, the corporate payroll accounts, and the retirement funds of the citizenry. The authorities are legally empowered to simply algorithmically confiscate a massive percentage of those unsecured deposits to cover the catastrophic, highly leveraged gambling losses of the bank. Your stored life energy, the fiat currency you labored for years to accumulate, will be instantly, mathematically deleted and converted into highly diluted, completely worthless equity shares of a bankrupt failing financial institution. You will not be asked for permission. There will be no congressional debate. The confiscation is hard-coded into the legal architecture of the global banking system. The specific, undeniable catalyst that triggered this architecture in 2026 was the absolute terminal detonation of the commercial real estate sector, or CRE. Following the unprecedented, globally engineered economic lockdowns of the early 2020s, the fundamental biological and physical realities of human labor were permanently altered. The massive, sprawling urban cores of the Western world, the towering glass and steel skyscrapers of Manhattan, London, and San Francisco, were suddenly hollowed out by the permanent transition to remote work and the systematic destruction of the localized small businesses that supported those ecosystems. These monolithic commercial office buildings are not merely physical structures. They are the foundational collateral supporting trillions of dollars of debt within the legacy banking system. During the era of 0% interest rates, institutional investors and commercial developers borrowed astronomical sums of cheap fiat currency to build and acquire these properties. They mathematically relied on near 100% occupancy rates and perpetually increasing rental yields to service the massive debt. But by 2026, the occupancy rates have violently collapsed. The rental yields have evaporated. And crucially, the era of 0% interest rates is definitively dead. A massive multi-trillion-dollar wall of commercial real estate debt is mathematically scheduled to mature and refinance in this exact temporal window. The developers who borrowed at 2% are now being violently forced to refinance their empty, decaying skyscrapers at 7 or 8%. The math is completely fundamentally impossible. The buildings are instantly, mathematically insolvent. And when a property that was appraised at $200 million a decade ago is suddenly dumped onto the open market and sells for $40 million, that $160 million hole does not simply vanish into the ether. It detonates directly on the balance sheet of the regional and megabanks that issued the original loan. As this commercial real estate contagion rapidly accelerated, it violently consumed the mid-tier regional banking sector. But instead of allowing these poorly managed institutions to fail organically, the regulatory apparatus forced the massive top-tier apex banks to absorb them. The system deemed the regionals too big to fail, so they fed them to the leviathans. JP Morgan, Bank of America, and their international equivalents were mathematically coerced into swallowing the toxic, rotting commercial real estate portfolios of the collapsing regional banks. This engineered consolidation did not eliminate the systemic risk. It concentrated it. It created a highly combustible, hyper-centralized financial powder keg, guaranteeing that when the rot finally reached the core, the failure would not be regional. It would be absolute, global, and terminal. The ultimate, deeply comforting illusion that prevents the domestic populace from executing a massive systemic bank run ahead of this impending collapse is the psychological pacifier of federal deposit insurance. In the United States, the citizenry places absolute, unquestioned faith in the Federal Deposit Insurance Corporation, or the FDIC, believing that their deposits are permanently, unassailably guaranteed up to $250,000. This belief represents a catastrophic failure to understand the basic, underlying fractional reserve mathematics of the insurance fund itself. The FDIC is not a magical infinite pool of sovereign capital. It is a highly leveraged insurance mechanism. The Deposit Insurance Fund, the actual physical fiat currency available to the FDIC to make depositors whole, routinely hovers around 1 to 2% of the total theoretically insured deposits in the American banking system. If a handful of small localized community banks fail, the FDIC possesses the absolute mathematical capacity to absorb the shock, quickly liquidate the assets over a weekend, and seamlessly reopen the branches on Monday morning without the public ever panicking. But the institutions of 2026 are not community banks. They are globally systemic, multi-trillion-dollar leviathans whose balance sheets eclipse the entire economic output of mid-sized nations. You must hold your own fiat architecture. You render the transition from too big to fail to too big to save mathematically irrelevant to your survival. The financial leviathans are collapsing under the sheer unpayable weight of their own arrogance. The only wealth that will survive the impact is the wealth you secure in absolute, unyielding scarcity. In the next video, I'll reveal something shocking. Don't miss it. If you enjoyed the video, don't forget to like, make sure to subscribe to the channel, share this video with your friends,